Hello, and welcome to the webinar, Forecasting 101 for Finance Leaders. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll dig into our discussion. First, we'd like to thank Bill for their partnership with today's event. They've been wonderful thought leadership partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Bill. We appreciate you joining us today. We welcome you to stay connected during today's event. For those of you who are active tweeters, please follow us on Twitter at Argyle Exec Forum. I also wanted to take a moment to touch on our content neutrality policy, which we've curated based on the feedback we received over the years from our members. Argyle is very proud and protective of this policy, as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. For those of you who are seeking CPE credit today, you must answer at least 3 polling questions and remain on the session for its duration. Polls can be found under the Polls tab on the right-hand side of your console, right next to Chat. Afterwards, if you're eligible to receive CPE credit, you will receive an email with a link to your certificates. If you have any questions about credits, please email cpe@argyleforum.com. Finally, and most importantly, please submit all questions that come up during today's event into the chat section of the interface. Let's begin our discussion. Joe, can you introduce yourself and tell us a little bit about your background in the field of forecasting?
Yep. So I'm Joe Yusko, VP of FP&A for a company called Redwood Living. We are a real estate developer, specifically in the multifamily space. We're in, I think, 9 or 10 different states now, all single-story apartment homes. We do our own construction, our own financing, our own actual development. So when it comes to forecast, as well as just the management and operating of the actual assets once they're complete. So when it comes to forecasting, we touch a lot of different things. We're forecasting off of, the macro world of, the finance environment, interest rates changing, those kind of things. We're forecasting off of construction costs, and then just overall forecasting the, multifamily space in general. So, we touch a lot of different things, which, is great, but also a challenge when it comes to, forecasting in the volatile market we've had the last couple of years.
Great, thank you. So the first question is, what are some differences between forecasting and scenario planning? And I'd like to call everyone's attention to the first poll, which is in the poll tab on the right-hand side of your screen. Joe?
So scenario planning to me is, you're thinking kind of a bigger picture of what can really affect your business. If you're familiar with ERM, that's kind of how I portray it. Enterprise risk management, that's kind of a big buzzword, and a lot of companies are kind of moving to having a enterprise risk management department. We have one ourselves. So every year it's a planning exercise from that department of what risks are actually going to can affect the business and how can we mitigate those risks. To me, that's kind of what you're doing with scenario planning. You're thinking of what can affect my P&L or just other aspects of my business that I need to be prepared for. And then when you're trying to layer in forecasting, the forecasting itself is, you're using historical trends, data that you have to kind of predict the future. And that's kind of the difference between the two is your forecasting is more, kind of analytical, where, scenario planning is bigger picture, kind of thought-provoking, ways of, kind of protecting the business. But there is definitely ways you can tie them together. And hopefully that's one of the next couple of questions. So.
And just to describe the poll responses a little bit, the question was, how developed is your organization's forecasting function? And the majority of respondents, 61%, said it was moderately developed, as opposed to highly developed or not at all developed. So Joe, our next question is, how can you align your forecasting with your scenario planning?
Yeah, so when you're thinking through your scenario planning and you're thinking of all these things that can actually affect your business, you're deciding how real those events may be. We're, I kind of mentioned, we're in the real estate space, and when it comes to setting up rents, the rents for our properties and how we project that rent growth going forward. If you look at like a historical trend, for 20 years, you might see about a 3% rent growth annually. The last couple of years, there was double-digit rent growth in a lot of markets. I mean, some markets had 20-some% rent growth. So you're taking into account, well, yeah, that scenario exists, and there's accelerated growth in rent, which is a scenario you need to take into account. But you also need to say, all right, well, how real is that scenario? How do I want to account for it in my forecasting? Do I want to say, well, the last couple of years have been 20% compared to historic 3%? No, you try to balance out those the scenarios that you're seeing and come up with a reasonable number that is a good obtainable number that for your actual forecasting. And that can go into any different part of your business. It could be, well, there's a lumber shortage or a microchip shortage. Oh, and how is that going to affect my business? And you would take those things that you can see in events that you're planning for and actually apply them to your financials, and to make sure that you're not going to miss it completely, but you want to make sure you account for it in your forecasting.
Great, thank you. The next question is, what's the difference between financial forecasting and modeling?
So forecasting, the way we use forecasting is, your baseline. We're setting up, if you're forecasting, you're doing a budget for your next year, year and a half to 2 years, whatever it is. You're looking forward, and your forecast is that baseline for your financials. When it comes to modeling, we look at that as how sensitive is your forecasting. If you see, if rent growth, for example, if we see a booming market, if our 8% projection turns into 10, that modeling, we can adjust the sensitivity to kind of reflect, what's our new outcome. Or if you see an increase in, insurance cost or construction cost or whatever it is, that modeling, you have your baseline, but the modeling is playing with the sensitivity so that you can, help see what the levers you may need to pull if this happens. So like if, lumber cost jumps by 15%, well, what lever can I try to pull to counteract that? Can we save money elsewhere? Can we speed up in a different part of the job to offset the interest carry cost or whatever it is? There's different things that you can play with when you are able to, see the impact. And that's where modeling really comes into play compared to like your forecast, which, is just your kind of baseline and what you're projecting for a longer period. Modeling might help you in a shorter span, adjust kind of on the fly.
Thank you. The next question is, what data do you need for quantitative forecasting? How do you get started if you're starting from zero?
As much as much accurate information as you probably can get. There's such thing as too much data, but you want to make sure you have enough to kind of accurately, portray what you need to. Historical data is always great. It's always a great baseline to start. In the last couple of years, we've seen big, increases in costs in a lot of different areas. So reaching out to our suppliers, getting their forecast, getting, their pricing that they're expecting to take in and layer into our models. Those kind of things are all needed to accurately kind of portray what you're going to see in the future. If you're going to get, a 20% increase in lumber and it hasn't happened yet, you want to be able to see it. I use lumber pretty consistently because that's one of our biggest, fluctuating costs in at least our construction environment. But also at the same time, you want to try to, take into account other risks of your business. And, if it's looking at, historical modeling for, interest rates, taking into account what the Fed might do. You want to take in just as much data as you can and actually apply it to your business to be able to actually come up with a reasonable forecast. I mean, it's pretty simple to just say, all right, well, here's my historical data and let's throw 3% on top of it, and 3% inflator for expenses, 5% inflator for revenue. But if there's always different things going on in the world that may not make it that simple. I wish it was, but if you can take into account other macro things or just things that you were able to get your hands on, it's really going to help your forecasting.
Great, thank you. So next question is, what are some ways to integrate your financial data, especially your payables and receivables data, into your forecasts?
So, a typical reforecast, you might, forecast your P&L, right? Your income statement, you come up with, this is the baseline for what this is going to be. But, there's different, everyone has different accounting methods. So you might recognize revenue in a certain period or recognize an expense in a certain period, but you may not be paying it in that exact period, just due to different payment terms or receivable terms. So if you have a reforecast or a forecast that you created, that's great. If you can take it the extra step and turn it into, forecasting cash, it's really beneficial to most businesses. Some businesses don't have, steady cash flow streams. Every single month there could be, some variance to when your cash is being inputted and taken out. So if you can layer in your, payable timing and your receivable timing, it's really going to help you. So like you have, you may be entering in a invoice today and it's hitting your P&L today if you're using accrual books, but you might have a deal with your supplier that it's net 30, net 60. So if you can layer in that timing into your actual cash flow forecasting, it's going to help you. And same on the flip side. If you're receivable, if you do work for a company and you are the supplier, you send them goods, whatever, and they have a 60-day pay time, you want to make sure that your cash can be planned that way. And that's where lines of credit and all those different things come into play if you need them, but your cash forecasting helps kind of give light where needed of where you might be short, where not. So it's layering in that payable and receivable data, not just going by how you're recognizing it from an accounting standpoint, is really important.
Great. The next question goes into a little more detail on this topic. What's the interaction between your payables and receivables function and your forecasting function?
You're kind of similar to how I just answered. You're really working together with those and your reforecast to make sure that the timing is right. You don't want to just be, you could recognize a revenue for a massive, deal that you're doing, today, and it could be a cash payment plan for the next 12 months. Just because you have a revenue hit to your P&L doesn't mean you're necessarily getting the cash in. So you want to be able to, plan from a cash perspective, not just from off the P&L. P&L is great, and that's how businesses are judged in a lot of ways. But the ultimate driver of your business is cash. So whether it's a payable in or receivable, payable out, receivable in, you just want to make sure that you're going to accurately portray that when you're actually trying to forecast cash.
So can you give us a little tour of what forecasting methods are available and how people can and should choose between them?
So really, forecasting, there's different methods, and I'll touch on a few, but you have to kind of do what works for your business. There's never just one thing that's going to fit. It's going to fit everybody. Kind of what I mentioned before, you can use like a straight line method where you're just taking your historical and you're layering in a inflator. And a lot of companies can do that if you have, a consistent revenue stream and a consistent expense structure. Some companies may not want to take the time to do a more detailed analysis. They're comfortable with, yes, we're dealing with X percent inflation. We think we can get X, growth in revenue. So they feel comfortable with just taking historical, throwing an inflator on it. But not all companies are able to do that. So there's, if you're a company that may have more erratic income or expenses, you can kind of do like a moving average, where you can look at like a historical trend and say, all right, well, I made 6 sales in 2013, 5 sales in 2014, and kind of so on. You come up with a moving average of how many sales you make for a certain period of time. You can apply that average with a certain sale price, and that can be your forecasting tool. It's not going to necessarily grab the ebbs and flows of when those things actually hit, but you can, for an extended period of time, if you're generally going to be working the same way, the moving average will help you just kind of come up with a good, whether it's a revenue stream or expense flow. It always gets you where you want to be for an extended period of time. It may not be an exact month by month calc, but overall it'll kind of get you there. Also, if you really want to get, analytical, there's companies that, base things off of, regression models. If you have certain metrics that you base your, business on, If you have, if we know that rent growth, like from my side, if there's a correlation between rent growth and, NOI growth, net operating income. So that's kind of the main drivers, at least financially for us. If I say that, for every X percent of rent growth, I get X percent of NOI growth. I know that correlation has existed for a long period of time. You can use a regression model, and it can kind of project for you if there's a strong correlation between the two. And you can do that for different metrics. I mean, if you have multiple metrics, regression formulas can do that same thing. It's kind of using, if you want to call it predictive analytics, but you're predicting off of the parts of your business that are pretty sound and the metrics that you're really comfortable using. I know that, everyone kind of creates their own method. I know we, from our budgeting standpoint, it's a kind of a blend. We'll have some account, like some GL accounts are just trended off historical, but others, when we're talking rental income, we're looking at almost a person by person and doing an analysis of what the rent is now, what it's going to be if they likelihood of them renewing, or if we're going to have a new tenant in there. We get extremely detailed because rental income is very important to us. But a different, you could have a line item for cable and door commissions or something like that, where you're just going to trend it. And almost every business is going to have those certain line items where you don't want to put too much thought into it. You're comfortable with where you are historically, but there's definitely areas that you want to really focus on. So a blend for most companies is probably the most common, at least, and there's not necessarily a one size fits all for anybody.
Great, thank you. The next question is, how can you speed up your forecasting process without sacrificing accuracy?
Technology. Always technology can always help. I know there's various tools. I get, from my side, emails constantly from different, FP&A tools or reforecasting tools, whatever they are. We're actually trying to get better at it ourselves. We're still Excel driven, at least in how we do the forecasts. We have we have an operating system that we use, and we also have some BI tools that are able to allow us to gather data quickly, but we still rely on Excel to actually do our forecasting. Our operating system is actually developing a tool that you can do the forecasting all within the actual system. We've been testing it. Unfortunately, it's one thing at a time. They make some strides in one area, which are great. Then other areas where we want to be more detail oriented, they might not be there yet. So it's always a push and pull with whatever system you're probably getting into, and that's working with your developers to try to work through those issues. But ultimately, technology is going to really be the driver for how you can do things faster and potentially more accurate. If you're just kind of pulling up an Excel sheet and entering in numbers, one, that creates manual error can happen. If you can at least do large data dumps that are reflective of your actual financials, and then working from there, or if you're able to pull large scale metrics or whatever it is, you really just have to rely on the technology to help. And for our side, we have upwards of 200 different LLCs that we actually do reforecast for. So it's a tedious process, but that's why we're really pushing hard to try to get better on our side of the technology. Even though we do have a lot of great technical tools, it's just something that you can always get better at, and there's definitely a need for it on our side.
I want to skip right to a question we just got from the audience because it's relevant to what you were just discussing. What tools do you use in addition to Excel?
So, like our operating system is called Yardi. If you're familiar with it, it's very specific, kind of the multifamily space. But we use Power BI, which is a Microsoft product. So what that does is it's every night we get a data dump from our operating systems. We have a few other ones in the organization as well, but we'll just stick for Yardi for now. It was a data dump that happens, goes into a data warehouse, and then through the Microsoft product, Power BI, we're able to tap into that data and then just do mass data dumps and mass data pools. So we're able to create reports like one time, and then based on the new data that comes in every night, those reports will refresh. So, we're never, we're far away from the days of when you had to if you wanted an update to a report, you had to go in, do an Excel dump, re-update your file. Power BI is doing that all for us all the time. And when we're looking at, from a reforecast perspective, we're just forecasting in general. We're taking the data, pulling it out of BI, doing our analysis, and then we're actually reloading it in so that we're able to we're not analyzing 200 individual Excel sheets. We're seeing it all in one snapshot of, you can have all 200 listed or, whatever view we really want. And that way you're able to see outliers, you're able to see different things. Like, we can come up with a broad brush approach. We can say, like, well, for all 200 LLCs, we think that we need to increase our rent by 3%. That might not be that might work for 75% of them, but it doesn't work for the other 25. And the BI tool helps us, narrow down where it's not working, and then we're quickly able to adjust rather than having to go through every single Excel file. So, Power BI is huge in our business. I know there's, that's not the, one stop for that kind of thing. There's definitely a lot of other platforms. We looked at Workiva, I believe, is a big one. Maybe just a few others, but just definitely a lot of tools out there that are useful and can really help your business.
Let's keep going down the path of discussing tools. Next question from the audience is, for cash flow forecasting, do you use treasury management software?
We do not. Definitely would be something, if you need it to be good, would be good to actually use. From our side, because of actually Power BI, we're able to automate a lot of that cash forecasting. Every day, like I said, those data dumps happen. We're able to get real-time cash views. So it's not a need for us, but if you don't have a real-time view of your cash, a treasury software would be great.
Thank you. And then the next tools question is, does Yardi provide both operating and financial data?
It does, which is very helpful. So we're able to have almost visuals in the same. We actually have a dashboard made for, if you're a person in the field or if you're like a regional manager, we have different markets. We have, Yardi has all the data in it so that when it actually dumps into BI, we can create all in one, snapshot view of where you are financially, what's your, what's your occupancy trends, what's your, projected move-ins, projected move-outs, all that stuff is able to be done in one visual through BI. But because Yardi has both operational and financial, it makes it way easier just because it does all work out of one system.
Hey, thank you. Let's zoom out a little bit and talk about the bigger picture. What are some ways that people can make their forecasting adaptive to changing conditions?
Obviously the modeling, we talked about that. And if you can create sensitivity analysis on the fly, that's great. It will help you when you're trying to look through what could actually affect your business. Ultimately, if you can rely on technology, that's great. We talked about how we're doing a lot of things in Excel sheets right now. We limit our reforecast for at least our properties to once a quarter, just out of ease of having to go through 200 different, Excel files and create them. The technology we're looking at would allow us to take our actuals and reforecast monthly. So would be a great change that we would just due to just time constraints, we wouldn't be able to do a monthly reforecast. We could do it, but it should be someone's full-time job every month. But with technology, we could, the technology we're looking into, it's a reforecast every single month that is done in a fraction of the time that it takes us to do our quarterly reforecast. So finding ways to rely on the technology, I know it's sometimes expensive. We're pushing back on the cost of the technology we're trying to use, but it's, if you can really get to a point where it's a cost benefit of the tech helping you make business decisions, helping you get faster information versus the amount of time or the amount of time you're putting in from a payroll perspective or just the cost of the actual product, it can really make a difference in your business. We've seen that we've made a massive investment in the Power BI space that has real-time effects on our business every single day. But there's always that cost benefit that you got to kind of weigh. So.
Thank you. The next question is, how can you use forecasting to identify ongoing problems? And I'd like to call everyone's attention to the second poll, which is about identifying ongoing problems. Go ahead, Joe.
It always seems like when you're actually reforecasting or you just are going through your budget season, you always point out, whether it's cost control or inefficiencies in your business. And I think that's one of the great perks of you can have a great forecasting or budgeting cadence. You can really kind of refine your business kind of as you're going through your forecasting cycles. We're going into a potentially volatile economy. Everyone has a different views of where we are in terms of is there a recession or not. And a lot of companies are planning as if that could be the case. And a lot of that was happening towards year end when we were going through that same process. So if we were going into our budget season, where are there costs available to be cut? Where can we be more efficient? Do we need all these new hires? Can we stretch it a year? All those things kind of come out when you're going through your forecasting or budgeting process, and it really helps spur the conversations. For us, from our corporate budgeting perspective, we have I think 16 or 17 different segments that make up our corporate budget. So we actually have 17 individual budgets that roll into one master corporate entity budget. So when we're going through that, we're each department, whether it's IT, HR, finance, whatever, we're going through, we're able to scrub their expenses individually rather than just at like a macro corporate level. At that higher level, it's sometimes harder to see where wasted dollars are or just inefficiencies are. But when you try to break it down and be more narrow, you can kind of see, well, maybe we don't need this right now. Or, oftentimes there's, hey, we've been paying for this, $5,000 a month expense for, 2 years now. Do we even really need it? Those conversations always seem to happen when a budget or a forecast is being done, just because there's actually a focus on it. And when you're focusing on it, things actually start to change. It's always, in almost anything in the business world, whenever you actually eyes are on it, things change. And if you're able, again, that's where technology comes in, because when you're able to put things, if you're able to create visuals and do things, much faster, when it's front and center to everybody, it makes a difference in your business a lot faster.
Great, thank you. And the results of the poll question was, has your forecasting ever helped you identify a problem that you weren't already aware of? And 73% of our respondents said yes, which was good news. Next question is, how does the kind of product or service that you sell influence your forecasting?
Yeah, it's almost going to have to. So I can almost take this from a different, like I kind of mentioned, we have facets of our business, and every one of them has a different revenue stream, and we have to almost forecast differently for each one. So, our standard, our properties, they're actually relatively on the easier side to forecast, because we have, first of the month, we know we have a revenue stream coming in, and we generally know what the expenses are. We know, costs for, turning a unit when somebody moves out. We know the cost for landscaping. Obviously, we are, talking to our suppliers in the front end before we're making our forecast, but to make sure we have the right cost. But once we kind of have those in place, for at least 6 to 12 month period, we're pretty accurate in what we think those are going to be. So, reforecasting there is more simple, because you have that very consistent expense and revenue structure. There's other parts of our business that are definitely not like that. Our development side, we have fees for we're buying a piece of land and doing due diligence on the front end so that we can ultimately create a property. So when we are doing all that due diligence, we get paid when the deal actually closes, when we get a construction loan on it. So when that happens, we have to try to project out closings. Closings are, especially right now, extremely difficult to predict the timing of. You have interest rate fluctuation. You have lenders, some lenders take longer than others. There's all these things need to be in a row for a construction loan to actually close. So when we're saying, we could be off, if you're off by a couple months on any one loan, it could be hundreds of thousands of dollars in revenue that is then delayed. So when we're talking about cash planning and those kinds of things, that's a big deal to that entity of the business, to where you have to then react and how, where's the cash going to come from because we didn't close 3 loans that we expected to. So that's a completely different way we forecast, and we do that with we work close with our lenders, try to be as accurate as you can, but there's always just nuance to that part of the business. And then our construction side, there's a revenue structure that's based on percent complete of the deal. So as we're overseeing the construction that's actually happening, we're paid a fee based on once we have a set fee for every deal, but it's paid out as a percent of completion. So if we're 10% complete on that job, 10% comes back to us in terms of our revenue. So when we're trying to forecast, we're weighing it, working with the construction scheduling team and trying to forecast out exactly where we're going to be at any point in each job that's open, so that we can try to actually correctly forecast our revenue. Another one that's extremely volatile, but we're try to be as accurate as we can. Fortunately, some things are out of our control. When you're dealing with municipalities and utilities and all that, it can sometimes just slow things down when it's not even necessarily up to you. But those things are always factors, and fortunately, we have enough historical data that we're able to come up with some formulas and like lead times that are pretty accurate and get us to a pretty good spot.
Great, thank you. So how does the stage of your product or services life cycle influence your forecasting? I guess apartment homes do have a life cycle, just a long one.
It is, yeah. I mean, I guess just from that, apartments, we're a long-term hold compared to this. It's actually different to a lot of people in our industry. A lot of people will build it and then it'll change hands multiple times. We're holding it for the foreseeable future. Forecasting for that, we actually do a lot of cash planning because it's eventually these roofs are going to go bad. Eventually, windows are going to go bad. Concrete's going to need to be replaced, and it may not be like for any given year. You may not have the operating cash flow to do that. So we're doing long-term cash planning on that side of it, just to make sure that 15, 20 years from now we have funds available and we're not doing cash calls to owners or something like that to try to get the funds in. So on that side of our business, we're always doing long-term looks at basically everything. And also just the line of business that you're in, you almost have to just take into account, how your revenue structure is going to be. If you have like, a handful of clients that you make, we'll say a piece of machinery for, and that thing's going to last, that one, unit might last 5 or so years, that you have to take that into account of your revenue cycle. You're going to be maybe selling X units a year, maybe to different clients, but you just have to make sure you're calculating that. I mean, you look at like a company like Boeing, for example, you're making aircraft. If something happens, the economy goes down, people aren't traveling, Boeing has to be working with their clients to understand how much purchasing they're actually going to be doing. If there's not as much demand, the airlines may already have enough planes, it's going to draw back. And that's where, communicating with your customers, your suppliers, all that, that really goes into your business is like really important, because you are getting the information directly from them and you're able to apply it to your actual business. That's, the case for, almost anything, no matter how big or small, just because it's, important to be on the same team and everything else with your suppliers and your actual customers.
Thank you. So what are some ways to find mistakes in the assumptions that go into your forecasts? And I'd like to note that the third poll is on the polls tab of your screen there on the right-hand side.
It's one of the, it's kind of sound kind of ironic, but I mean, just common sense. I mean, that's kind of the best way to, when you're looking through things, your business. If I'm looking at something and I see that, hey, this one category is increasing 20% that next year, and we've never seen that kind of an increase, you're going to naturally just dig into it. And a lot of times, if there is a mistake, that's how you're going to catch it. If things are making sense, then it's generally going to be in line. I mean, I can tell you, I'm not looking through all 200 LLCs reforecast every single time. I'm looking for anomalies, and that's where for us, Power BI really comes into play. Is it possible there's mistakes in half of those? Yes, but if it's within a certain degree of error, you're generally okay with it as long as it's looking in the big scheme of things of how you expect your business to be run. If I see rent growth at 15%, I know that's probably not going to be the case, and then you're able to drill in quickly and adjust for it. And that's kind of how you almost have to go about it. I mean, there's various tools that you can tap into. We have not yet dabbled in the space. I know AI is getting big in at least the payable entry and potentially the correction of things. I've seen some articles about how that's intuitive, where it will learn how you code things and actually start making the journal entry and corrections for you. So we're not there yet. Want to get there one day, but you have to rely on your actual common sense, what you know about your business, and then use the technology or whatever tools you have to kind of just cipher through the different anomalies that are just going to happen in your forecasting.
Thank you. And the full question was, in the past year, have you had to change a key assumption in your forecasting? And the majority of respondents answered yes, that's 60%. So thank you, Joe, for that insightful discussion. Let's open up the webinar for Q&A from the audience and encourage our attendees to submit questions using the chat feature, which is also on the right-hand side of your screen. So why don't we jump right on in with the questions. And the first of which is, we are struggling to increase the accuracy of our financial forecasts. Do you have any advice for us?
I guess I'd love to know more, but I guess at a high level, I guess how are you, if you're basing it off of like a historical context, where are you missing? And if you're constantly missing one particular line item, if you're saying if your revenue's off or your expenses are constantly off, where and why? Are you missing it because you're just not understanding the expense structure or revenue structure, or are you missing it just due to economic factors? And if it's obviously if you're missing it because of not just understanding the financials themselves, or just maybe you can be better on understanding the expense side or revenue side. The internal things are a lot easier to correct. So if you're looking at how you're missing and analyzing where and why you're off, that's a great way to start. When you get into kind of the economic macro things, it's a little bit harder, and that's where you may be able to use a different method of your forecasting. If you're missing because just the timings of things, that's where maybe like a moving average or something like that could be beneficial, rather than like a straight line or something. But really just if you can correct anything internally first, that's going to be the biggest benefactor, I guess.
Great, thank you. The next question is, what's the biggest mistake you've seen companies make in trying to increase the accuracy of their forecasts, and how did they get past it?
Well, some companies will throw a lot of money at about anything if they think it helps, and that's where kind of I talked about. It's great to just throw money at something and hope that it'll fix it. But if you don't necessarily have, I could buy a great software today, but if I don't actually understand my data and I'm paying for, I'm paying $100,000 for this software, you still have to understand your piece of it. If you don't, the software is only going to help you so much. So if you're able to you still have to see your business, know the ins and outs of your business, at least from a financial standpoint, and know what's really going to be when we talk ERM, if you don't know your risks and you don't know where your revenue misses or expense misses could come from, no software or anything's going to really benefit it. So you have to kind of know that. So before you kind of get into bed with any one particular software company or whatever, make sure you know your side of the business inside and out. Because although it'll help, it's not going to be the perfect solution by any means.
Great, thank you. The next question is, we've made some inaccurate forecasts lately and have lost a lot of credibility with the rest of the business. How can we move forward?
projections are always wrong. I mean, I can tell you that the day you do a projection, it's going to be wrong. It's just a matter of how wrong. And the business itself has to kind of understand that, not every single thing is going to be, like I'll be honest, I'm not 100% accurate all the time either. Last year, for example, of our properties, I think we were about 4% off in revenue, which translates to millions of dollars. And we were off because it was a booming market, and we were off. I mean, fortunately, we undercut what we thought we were going to be. So when you have more revenue, people seem to forget it. But when you're dealing with outside factors, sometimes then you can't help but be wrong. You just try to if you're able to look at why you were wrong and correct for it, that's basically the best you can do. But if you're consistently off on one thing, like I knew we were off because our rent growth was way higher than what we actually budgeted for. That's fine. This year we corrected it during budget season, and so far we're within 1% of revenue. Doesn't mean that's always going to be the case, but if you can just kind of understand where and why you're off, that's just a great way to eventually get back on the side you should be on.
Great, thank you. So next question is, how can we use our financial forecasting to persuade outside investors to invest? How can we navigate presenting our forecasts without encouraging potential investors to lean on them too hard?
We deal with that same thing. So when we're modeling a new deal, we find a piece of land, we do due diligence, it's buildable. We have a whole process internally that we create a pro forma. We layer in construction costs, what we expect the construction timing, how what we expect rent to be, and we're projecting out all of these things to be something that's we start building today. You're not completely built and fully rented for like 3 to 4 years. So we're trying to guess what rent is at that point. Obviously, we have some checks along the way. We do appraisals and those kind of things, which are gut checks to us, and those are our share with investors. But you have to, if you can do, accuracy over time always gets better. If you're doing the same thing over and over again, you kind of, get accuracy. You build, natural rapport with your investors and how they can expect things to turn out. Doesn't mean every single deal is going to turn out that way. We've got deals that were home runs and deals that, we have, long hangouts where investors are slowly getting repaid. But that's just the reality, and you just want to be as accurate as you can. And basically your track record over time is really the only thing that's going to justify that in a lot of ways. But it's just getting better and learning as you kind of move forward.
Great, thank you. Next question is, we are having trouble recruiting and retaining people with financial forecasting skills. Do you have any thoughts on what we can do?
No, it's a definite challenge for sure. Good thing is that people are always needed, but if you're able to offset the lack of human capital with technology, that's always a great way. I mean, we're looking at the technology that I've mentioned a few times would potentially save somebody's to be about 2 weeks every quarter, and that translates to payroll dollars. That's not going to necessarily be a full person every year, but it can really help you. And we use other aspects of technology in our business that have taken staff dramatically down. When it comes to actually recruiting, generally I look for younger people out of college. Doesn't mean that's always great. When I look for accounting students that are generally more technically sound, that generally can lead to them understanding Power BI, those kinds of things, but doesn't mean that you need to go. You can't go with somebody who has a lot of experience too. So it's always a tough thing to try to get the necessary human capital that you need in.
Thank you. So how do you think the forecasting function is going to evolve over the next couple of years?
Well, definitely through the use of technology. It's we kind of keep saying that over and over again, but it's definitely the way of the future. I mean, the days of Excel are long gone. I I'm like a dinosaur myself when it comes to Power BI compared to what some of my staff can do. I was old school, could do a lot of things in Excel, but now everything in Power BI is a completely different language to me, and that's just technology evolving and getting to a point where you just have to adapt and really just embrace technology that is existing and what it's going to be. Like I said, AI most likely will be the future for a lot of things, whether it's full scale doing everything for you, or just taking your data in and starting to run with it, or just general automation of financial reports. That's a big thing that I keep hearing about now that a lot of companies are adapting to is like for us, we have lender reporting. We're trying to just get a program to actually just run all the reports needed every single month instead of a staff member having to do that. And that'll be the same way with forecasting. You'll just be plugging in your initial data points, and the system will initially spit out the output, and then you obviously have to probably refine from there, but that's where it's ultimately going to be heading.
Thank you. So next question is, can you describe your software to forecasting to presentation tech stack as a guide on how to develop the process?
Can you say that one more time? Sorry.
Can you describe your software to forecasting to presentation tech stack as a guide on how to develop the process?
Not familiar with tech stack, but I'll give it a whirl. Our general flow is, we have over the course of a month, through Yardi, which is our operational and financial software, everything is inputted. Our accounting department goes through their typical month close. Once that close is complete, we'll start to extract data, and we're extracting it, dumping it into Excel, manipulating where we need to, and then it's essentially reloaded back in so that we're able to pull it into the Power BI software. Once we look through that, we're able to adjust outliers, those kinds of things. And then, yes, within Power BI, where you say presentation, that's where we're creating the actual presentation view. So like we're not showing to the C-level a list of 200 LLCs and the various percent increases or decreases or what the income's going to be or revenues, whatever. It's consolidated. We use consolidated subsets, whether it's a same store subset or different subsets that we have and we're familiar with in our business, to kind of show how things are trending. We have different life statuses for each one of our properties. So same stores, the more consistent reporting function, but if you're looking at an overall cash view or something from the CFO perspective, the Power BI is a way that we consolidate all that into one quick snapshot view. It goes from a lot of data down to basically a one-page view for him, and that's all possible just through the use of Power BI and any other technology that you can get your hands on.
So in addition to Yardi, Power BI, and Excel, what other technology does your company utilize for your finance team to communicate with investors, other internal teams, and senior management or operational teams? And operational teams are characterized as the boots on the ground leaders.
Heavy Microsoft products, I think we have the full suite. We have staff all over, but in larger the Midwest and the Carolinas. Teams, different, Yammer, I think, is one method that people communicate through. So different Microsoft products is how we generally communicate. When it comes to investors, we use a company called Appfolio. It's, the way they have their own little portal page. They can see, their different investments, those kind of things. And, we also have our construction software. We have a construction software called PM Web, and we have a ACQ kind of it's really just a portal that kind of keeps every deal in line until it gets to construction loan. It's called DealPath. And then, we also have, some internal development team that will build, various things that we, use internally just to, house data or just kind of keep things straight. So kind of a handful of things. I'd say largely Microsoft is the main tool for the majority of communication and exposure in the business.
Great, thank you. The next question is, how can we train recent graduates to make financial forecasts?
Breaking it down. I think if you just walk up to somebody and say, "Hey, I need you to do this for your forecast," well, they're probably going to not exactly know where to start. If you can break it down into individual aspects, it just seems to help make it simpler. I mean, I have 2 people on my staff that are less than a year out, and if you break it down to hey, let's just start with revenue. Fortunately we can, with our, at least when it comes to the properties, we have a consistent revenue stream, so we're able to say they can see kind of growth over time. If you break it down and say, all right, well, this is kind of how we want to project cash flow off of this or whatever, and then you work your way to expenses. And then you kind of follow that through, and just breaking it down into individual things, it definitely helps. And even when we're doing our budgeting process, we get input from all different people within the organization, and no one person on my team is sitting there trying to, make a shell from top to bottom. It's input from various people. Everyone has their own little area of expertise, and if you're able to break it down while still they understand how to pull it all together, that's, at least from my experience, kind of the best way.
Thank you. Next question is, would you hire a remote worker, or do you prefer hybrid workers only?
Wouldn't be against remote. I actually have a full-time remote worker on my staff right now. So majority are hybrid. I think 2 to 3 days in the office is probably the norm, but definitely not against remote workers. I guess in this, in the finance accounting space, you can, as long as you have to have the right employee, and you have to build a trust factor there. But this is definitely a profession that remote work is definitely capable.
Great. The next question is, can you go into a little more detail about what AppFolio is and what it does?
It's just more of a login for our investors. It's a communication piece as well as just what they can see. So if I had X investment, I could log in, see any information that relates to that investment. If there's been distributions out, it'll show up there, as well as just a platform for our investor relations team to interact with the investment. They can send out mass messages, give notes on, if I'm an investor in a certain property, they can see those different things all within that software. It's just generally a front-facing software for the actual investor.
Great. Thank you, Joe, for this excellent discussion and for really ably filling in for Brent Berger and Neville Kadimi, who couldn't make it today. Thank you, everyone in the audience, for joining us for this excellent webinar. Thanks again, and enjoy the rest of your day.